Coming to tax group, you have a multiple companies. You need to check whether you have eligible to form a tax group. And if yes, need to check and decide whether you want to form a tax group. And you should need to carefully look at the advantages and disadvantages of forming of a group and decide. Creating a tax group is entirely different than VAT tax group. Under CT rule, only parent company and its subsidiary can form a tax group. Whereas under VAT, it is very much easy. Even common control is enough. Parent company should hold 95% of the share capital or 95% of the voting rights or 95% of profit share, and would also allow direct or indirect holding is enough, and must follow both the parent and subsidiary must follow the same financial year and same accounting standard, and neither the companies can be exempt person or a qualifying person. If all of these conditions are satisfied, then only you have a tax group can be formed. Let us go through some scenarios. Let us see here all companies can form a tax group. For some reasons, if you don't want to include a company in that group, that should be also possible subject to approval from FTA. So here you can form a probably separate tax group like ABCD, ABC LLC and XYZ LLC, or a UAE holding company and PQR, or a may form one group with the UAE holding company, PQR and XY, and keep ABC out of this group. Actually, any permutation or combination except ABC, PQR is possible. Let us another example. This one PQR change it to a free zone company. That itself we cannot make a tax group as a whole. But in this also we can make some side group like a UA holding company, ABC and LLC like that. Coming to this one, the UAE's holding company, we cannot, that is a non-resident company. We cannot make a complete tax group, but we can make some other groups like ABC, LLC and XY LLC, we can make a tax group like that. No other group is not possible. Means ABC and XY is resident company, that is we want to make the possible to make the tax group. Qualifying group. Coming to qualifying group, if you have multiple companies and is unable to form a tax group and holding less than holding 95%, law has given some incentive still. So IT law was introduced a concept called diluted means qualifying group, not called qualifying group. If you are eligible to form a qualifying group, then asset and liabilities can be transferred without profit or loss. Law also speak about another group. We call it as a diluted qualifying group because conditions are almost same, and only difference is that non-resident companies cannot form part of diluted qualifying group. In this group, loss incurred by one company can be netted off against the profit of another company in the same group. A typical example is given in the diagram. You need to check and utilize the incentives provided by the corporate law. With this, I am handing over.